We've talking about cost segregation and bonus depreciation today. What is a cost segregation in the tax code that allows investors like us to take advantage of depreciation in our investments to get us passive losses? And the cool thing about that is passive losses can offset passive income, like from our syndication deals or rental properties. And if you're also unlocking the cheat code to doing real estate professional status, you guys can also possibly offset your ordinary income, such as coming from your job. Now, every situation is different, and that's why I always say join up with our group, get more educated, check out the e-courses, book an onboarding call with myself and talk through this stuff on your own. If you're a lot of the lurkers out there that are super shy, I get it. We're all introverts in our group. You guys can check out in the members website all the old coaching calls. Just we arrange that page based on net worth. So go find your compadres in your net worth range, and you may find yourself not a special snowflake, but one of the many. On the podcast today, I have AJ Lyons, who's from Do It Yourself Cost Seg, to talk a little bit about first, what is cost segregation? I gave my definition, AJ. Why don't you give yours? Since I think the cool thing is like everybody explains it differently. And
I always look forward to discussing cost segregation and how we could potentially help people reduce their tax burden and save a little bit of money. The way I always like to describe cost seg is cost segregation allows you to accelerate depreciation portions of your building and site by identifying them as personal property. So if you think of a pie, we're going in, instead of you having that whole pie in long life, which is going to be your 39-year or 27.5-year straight line depreciation, we go in and we divide that pie. We divide that up and we split it out into accelerated. So that would be your 15-year or your 5-year short life depreciation. That's your benefit. So exactly right there, there's the visual description of it. And that's the easiest way to think of it, is that we're going in and we're breaking out those land improvements, which is going to be your 15-year property. And that'll be able to be taken in 15-year short life. And then we also have your 5 or 7-year, which is your personal property. At a high level, that is the simplest way to explain cost segregation and what it does for you.
And for those of you guys listening on the podcast, we're taking a look at some of the images as we're going about this. At the new website, the wealthelevator.com/COSTSEG. So apparently a lot of the millennials, the Gen Zers, like to listen to the podcast on YouTube and let it roll. Once in a while, you get some added features such as these images that we're putting up. But if you're listening on podcast land, just try and imagine it, I guess, the pie chart.
Yeah, definitely. And some just like easy numbers to wrap your head around is, if the cost segregation study gave you a benefit of $100,000 in depreciation for the first year, that could be $37,000 in extra cash flow if you're in that 37% tax bracket. So obviously you're going to want to apply that to what tax bracket you're personally in, but that's how you go about seeing the benefit first year that you'll receive.
And we're going to be going a little bit more into the details because nothing wrong with that. If you're just a straight passive investor, what the heck does this all mean to you? Exactly what AJ mentioned, right? Tax savings using these losses. Of course, you've got to work with your CPA professional, and we've got referrals for that. And just shoot us an email. How do you get those losses? Here are some real K1s that I've personally gotten back, or maybe I've taken this from some of my, this guy, he made $100,000 investment and he got $121,000 in only the first year. So that's not even including the rest of it, which is totally losing money on paper. Thumbs up. And that's one, right? Like that was a more exceptional one. The guy invested 180 grand, got $176,000. I'm trying to find some worst ones actually.
Yeah, I was going to say, in our experience, some of the lowest cost basis reports that we've seen run are in I believe the lowest one I saw was $30,000, and they still received a benefit. And now that's going to be because they used online option instead of doing a fully engineered study. So the cost for the study is much, much less, which allows your benefit to be greater, obviously, since you're paying less for the cost segregation study itself. So we have seen people with cost bases as low as $40,000, but I'd say sweet spot that we see is in between the $100,000 to $300,000 range. And when I say cost basis, I mean your purchase price minus your land value.
We're looking at these K1s, and when you're a syndication investor, you get the benefit of not having to do anything, and typically your sponsorship team will be doing a cost seg if it makes sense, of course. And you'll be an equity holder, and therefore as an equity holder, you get your pro rata share of the losses and bonus depreciation. And this is a $42,000 investment. They got like 25 grand in first year losses. And of course, there's the losses in year 2, 3, 4, 5, and beyond trickle in. I would say a third. Is that the good general rule of thumb, AJ? Like in the first year, you get a third of the possible total losses front loaded in that.
I would say it's a good general rule of thumb. Obviously, it depends on everyone's individual situation, but yes, as a rule of thumb, I would agree with that.
Yeah. So I think, again, as a passive investor in a large syndication, which most accredited investors gravitate to you, that's all you really need to know. Next podcast, move on. But if you're somebody who is still messing around with little rental properties, or you wanted to maybe do some cost segregation on some personal assets and get some benefits there, which is a little bit more of an advanced move, continue on and listen on to the rest of the podcasts. How people are using this on their little rental properties.
Yeah, so as far as little rental properties, a mom and pop operation where you're still involved with day operations, whether that's just managing the crews that go out, do the cleaning, all that sort of stuff. We're seeing a lot of people take advantage of bonus depreciation. And like you had mentioned a little bit earlier, qualifying for that real estate professional status. And what that allows you to do is it really takes cost segregation to the next level. It allows us to accelerate that depreciation that we would normally get and have to extend over, we would normally accelerate it over 5 or 15 years. The bonus depreciation allows you to take that all year one. So the whole amount in your 5-year and the whole amount in your 15-year, you can accelerate that and take that all year one instead of, like I just said, having to spread that over the 5 and 15-year. There are some caveats to that, like we mentioned earlier, about having to qualify for real estate professional status and what qualifications those are. I believe one of them is spending 700 or 750 hours annually materially participating on the management of your rental business. Like we've said before, you're going to want to check in with your CPA, your tax professional, to go into the details of that, because everyone's situation is unique. But that's just the general overview of what a lot of people are doing to maximize cost segregation and its benefits right now. And that bonus depreciation will be phasing out as we move on. So in 2023, we're at 80% bonus depreciation, and next year that will drop to 60%. For any properties that were acquired in between that 2017 and 2022 timeframe that you have not done a cost segregation, on yet, but you did place it in service as a rental during that time frame, it will still qualify for 100% bonus depreciation.
Just new acquisitions going forward, it goes to that step down.
Yep.
Basis.
So if you purchase something this year in 2023, just place it in the service, that's where it's going to be at the 80% bonus depreciation.
Yeah. And I've been getting some K1s back for 2022. And that was the first year where it went down, right? From 100% down to 80%. And this is just me in an anecdote. And of course, every deal is different because every deal has different percentages of loan to values, loan proceeds, leverage, and then varying amounts of CapEx amounts in there, and age of properties are some of the big factors in how effective a cost segregation is. But I haven't really been seeing too much of a difference between 100% or 80%. Is that kind of what you're seeing? The bonus depreciation, I've always thought was like the syndicator is a little dirty secret to trick people into some sense of urgency. But
yeah, I look at the bonus depreciation as a cherry on top. Cost segregation has been around and been a benefit for a long time. So it's nothing new. People were doing cost seg before bonus depreciation even came into play because it just still made sense by the numbers. And now that bonus depreciation has come along, like you said, people are using it to create a sense of urgency, but we look at it as just that cherry on top. If you can easily qualify for that, great. Get you just even more benefit up front. If you can't, no worries. You'll still get benefit. It'll just be slightly delayed. And if you're holding the property, that's not going to be a problem anyways. And you don't want to be doing a cost segregation property if you plan on flipping within the first year. That usually would not make sense. And that's one thing you could check out on the site using our estimate feature is plugging in your actual numbers, seeing if it makes sense for your property and what you may receive that first year in accelerated depreciation.
Yeah. If you guys want access to that tool, you can check out thewealthelevator.com/cost-seg. All the links, and then this video will be there. And I think we've done past videos too, so you guys can check up those resources there on that page. Yeah, I haven't really seen too much of a difference, maybe when it goes down to 60 or 40%, but you don't have a rough general rule of thumb with 100% bonus depreciation and you got 100 grand of losses. If it was 50% bonus depreciation, it's not 50%, 50K in losses. It's probably more like 70 to 90% of
Right.
what you would have gotten, right?
When it goes down to 50%, say you had $25,000 allocated to your 15-year and $25,000 allocated to your 5-year, obviously you're going to take 50% of both of those numbers. That's what you're going to be able to accelerate and underneath bonus depreciation. That remaining amount is still accelerated in 5 and 15-year. It's just spread over that time frame instead of the one being able to take it year one.
And I think we're definitely getting into the weeds here for all passive investors. Definitely not really important to focus on. A long story short, it's just bonus depreciation, as AJ says, the cherry on top. But
Yeah.
the vast majority of the benefit comes from just the plain vanilla accelerated depreciation cost seg.
Now, one thing I want to just quickly bring up that I've been seeing bubbling around with different CPAs and tax advisors is people are using what they're calling the short-term rental loophole. And as long as your short-term rental is rented out for 7 days or less all year to the different people that are renting it, they're saying that you're able to use that against your W-2 income as well without qualifying for the real estate professional status. I don't have all the details on that, so definitely check in with your tax advisors and your CPAs. They'll be able to give you more information on that, especially on your unique scenario. But I do know that is something that is being done to just to help add a little bit of benefit for those who can't qualify for real estate professional status.
Definitely one of those more scrappier plays that some investors are doing. I may argue that if your net worth is a couple million or greater, buying a pain in the butt rental property, especially when it's expensive in California, like where most of our
Yes.
investors are at, as we say in Hawaii, it's pull hole. It's not worth the brain damage and the
I could
risk
agree
of
with that. The
audit.
bandwidth that you would just have to spend thinking about that, worrying about audit potentially.
Yeah.
Obviously, one great thing with the DIY system is we do offer that audit defense for people to give them that ease of mind. So if you do select that, we obviously will go ahead and help you out and correspond with the IRS on your behalf as far as the cost segregation study goes and help you with anything necessary.
Yeah. But as far as when somebody is trying to sharpshoot the whole short-term rental loophole, that insurance does not cover that. It's my assumption.
If it went to audit and they're bringing the cost segregation into audit, we will go there. If it's about the short-term rental loophole, that's obviously between you and your CPA. If it was obviously something that they're questioning in the cost segregation study itself, then we'll help you, obviously, no extra charge.
Yeah. So maybe let's talk about that a little bit, right? There's a couple of options for people. There is the more cost-effective way, which I think makes sense for your little $300,000 little property. When we do a cost segregation, we're typically paying what, 5 to 10 grand, because it's
For
not that
fully
much
engineered.
money for the full study. Because especially we have large syndications, so we typically have the money to pay and get the good stuff.
Right.
But for investors with the smaller properties, it's definitely not cost effective to do a
Exactly.
5-10 grand cost seg. But maybe, yeah, one does one make more sense than the other? What have you seen
Well,
investors
definitely.
do?
We've been in the business over 20 years, so we have a sister company that does those fully engineered studies. And what we saw was that a lot of people were missing out on the opportunities because, like you said, Lane, of the price tag of $5,000 to $10,000, somebody having to be flown out there. So what we were able to do is use our historical averages. We've gone out to thousands and thousands of sites and taken photos, detailed notes, everything like that. So that's what we were able to do and use to build out our system. And what you can do now is go directly on our site. And Lane was saying in that $100,000 to $500,000 cost basis range, going directly onto our website, filling out the form yourself, and getting the instant report is going to be your best option as far as the price you're paying, the time it takes to receive your report and be able to apply those benefits. If you have a unique property or you start to get up to a higher cost basis, it could make sense to go a bit more detailed and get into the weeds a bit more. So what that looks like on our site is what we would call a hybrid or a detailed study. And what that's going to do is provide, like, a hybrid study is going to provide more information on the site components. On our instant reports, you receive underneath the 15-year a site improvement one total number. That encompasses all of the site improvements that you let us know were on the property in a single number. In a hybrid study, we'll go ahead and take your appraisal, look at Google Earth and other factors like that, and break out line by line all of the things that make up your site. So some people will like to see that added layer of detail and breakdown, and it provides a little bit more just a sense of security for them. And some people like to be able to provide that to their investors and see that information. We also provide what we call the detailed study, and that's the easiest, most hands-off for the client. We take over the whole operation. So we're going to get the appraisal from you if you have one, or interior photos, etc. And we'll go ahead and create those notes. It's essentially a desktop study is what it's called in the industry, where the engineer isn't going out to the site, but they're viewing the appraisal, any plans that may be available, any photos, and we will assess and create those notes for you. We'll do the same for the site components, and then we'll provide you a detailed report, which is going to be our most in-depth and broken out report. So that's the different levels that we currently offer on the site.
And I guess what is your general recommendation based on what are those price points at? When does one make sense for a certain one, and kind of what's the price point for that, I guess?
Around $3 million, we would like to talk to you, cost basis wise. Underneath $3 million, for the most part, it makes sense to just run it directly on the website. There have been even times in the past where we'll pass along clients to our fully engineered branch of the company because it just makes the most sense for the client. That's when we get up into the $5 to $10 million range typically. There are other times when it's specific types of projects like a mobile home park, RV parks. They can be very beneficial, but they're all so unique that we just need to handle those manually still. So that's another project that just has that type of unique factor.
One question that sometimes comes up, which I don't know if it's a super valid question, but it comes up, is which asset class gives you the most depreciation? And I say it's not super valid because you got to give up the damn depreciation anyway until exits. But which one, or is it negligible?
No, there actually is a decent difference. I'll say one of the better kept secrets right now, or during 100% bonus depreciation, was that gas stations and oil change facilities were they were the most beneficial. The reason being is that because the majority or all of that building component could be considered 15-year. If you qualified for bonus depreciation, you get to accelerate 5 and 15-year completely year one. So you're taking the entire amount in year one for those types of buildings. And obviously moving forward, it will be 80%. That makes those the most beneficial during bonus depreciation time.
That's going away a little bit. Yeah.
That is going away a bit. Like I said, that'll phase out. So as far as more of a general standpoint, I would say condos and mobile home / RV parks. The reason being for those is because the portion of the pie is smaller in a lot of those scenarios. Take a condo. You don't own the structural elements of a condo. You're down to your 5-year and your 39 or your 27.5 year, depending on whether it's a short-term or a long-term rental. So by the very nature, you still paid the same amount for a condo that you may have for a single family residence. But since it's split between 3 and the single family residence, and now the condo is only split between 2, your 5-year is going to be elevated for a condo. So on average, we're seeing about 30 to 40% short life depreciation for a condo, whereas a single family residence, depending on the finishes, we're seeing 20 to 35%, with that higher max side being hit when you have a pool on site, when you have granite countertops, all qualifying wood or whatever qualifying wood flooring that you may have, etc. And then going down from there, the lowest benefit that we typically see is in like a warehouse. They're pretty bare bones. There's not a lot of qualifying materials. So we'll typically see anywhere from 10 to 13% on a warehouse. So those are just some general averages that we've been seeing over the past year.
Those N% doesn't seem too much to jump outside a building to invest in a bad deal to just pick up depreciation. But maybe that gets my head moving a little bit because it's that 15-year, which is like roof components, which is the heavy thing that benefits, it sounds. And maybe that's a good segue into my next question is like what I've heard what some people will do is they'll buy a house like a condo, right? And turn it into a commercial property, rent it out, and then do a cost seg, but then move into it. If you've been seeing people do this little tricky maneuver.
I actually have not seen anyone. No one's brought it to our attention, at least, who's done that.
Yeah,
Maybe they've done the cost seg studies with us, but I have not heard about that maneuver yet. So what all
yeah.
does that entail? Because you're able to, when you move into it, though, don't you have to claim it as a personal residence, or how does that aspect work?
Maybe you don't have to give up the losses until you exit the asset,
True, until
right?
you sell the property.
Yeah.
Yeah, that's definitely something
Gets
to look
my
into.
head
I'm
moving
not.
now that
Yeah,
you hit me off that condos are a little bit more slightly juicier.
they're slightly juicier right now for cost segregation. Like I said, on average, we've been seeing that 30 to 40%.
Yeah. But hey, this podcast is all infotainment for everybody. This is hey,
Exactly.
this
Make
is
sure you're checking in with your CPA and tax advisors for your specific scenario, and that we can help you out with the cost seg portion of it.
yeah. I guess before you run off, any other, quick questions you get up common from investors?
Some quick things would be for our aspect, it's more of when you're actually filling out the information and stuff like that. And we have a lot of resources as far as that goes, as far as video walkthrough, our FAQ page. Obviously, you can always reach out to Lane or us directly and get assistance. I would say determining land value is one of the most common questions that we get. And what we would say for that is if you're unsure of your land value, one of the places that we send people is the county tax assessor or the property tax appraiser. You want to go on there and see what they've appraised your land at. You don't want to take that exact dollar amount. You want to see the percentage that they've allotted for land. And then you want to apply that percentage to your purchase price and then use whatever that percentage is as your land value. Like I said, that's the biggest question that we've got. Again, we're not land appraisers, but that's how we've seen it done most often. And it's held up that way the best when the IRS has questioned it, because you're able to say, hey, I went directly to the property appraiser's website. I took the exact percentage they were using and just applied that to my purchase price. Because land is non-depreciable, so we're excluding that. But if you're trying to, we have seen people in the past who have tried to do a sort of ridiculous land number, a very low one, because they want to maximize their benefit. But in the end, if that triggers an audit, that's not going to stand up and it's not going to be worth the headache and the money that you're going to spend dealing with that. So you'd rather do it right the first time, talk with your CPA tax person, but that's how we have seen the industry standards go as far as determining your land value.
Yeah, the fundamental of what do they call it? Hogs get fat and pigs get slaughtered. Maybe
Exactly.
it's like some people they're like they think they're super clever because they learn about this S corp and they do it themselves and they pay themselves $1 and then they get audited and it just looks
Exactly.
ridiculous and
Right.
obscene.
Yep. And it's the same thing with your real estate professional status. If you don't qualify for that, don't try to push for it because they're going to want to see documentation of the hours that you spent to qualify for that. They're not just going to take your word for it.
Yeah. Going back to your land value, I'll give people loosey goosey rule of thumb back of the envelope here. Say you're buying like a $30 million property. To me, what I do is people ask, hey, how does the losses look first year? What I'll do is if it's in a cool area like California, where probably you don't want to invest anyway, but there the land values are worth a lot more. So
Right.
I typically skew it to 2/3 of that $30 million the land. Therefore, the $1 million 1/3 is the improvement value, which you depreciate. But a lot of these like less cool places to live, like
Just going to
Texas,
say, we've seen some in Missouri where the land value is very low.
yeah, yeah. I
Yeah.
usually use 2/3, but I don't know if that's a better than nothing. So
Better
in
than
that case,
nothing. And I have seen that in general being done with people who are investing in areas like California where prices and land values just seem to be very elevated. One of the other things that we get asked a lot is, hey, I just found out about cost segregation, but my property was placed into service a couple of years ago. Can I still do a cost segregation? The answer to that is yes. Obviously, the sooner the better when it comes to a cost segregation study, just because the ease of getting it to your CPA and getting it implemented, it's the easiest then, and the information is the freshest in your mind as far as having to provide that for the study. But if it is a couple of years, it's been past two tax returns that have been filed and you're just finding out about cost segregation, you can have your CPA do a Form 3115, which is a change of accounting method. I believe it's section 481A that allows you to go back, say, hey, I didn't do cost segregation on this property that was placed into service. We're doing a change of accounting method. We had the cost segregation study done, and now we're going to implement that. and then you can still get the benefit that way. So it's not too late. Let me caveat that. If it's been 15, 17 years, it may be too late. You're going to want to run the numbers because you'll have already gone past and taken the 15 years has already elapsed. So you're not getting any of that benefit anymore.
You've already drawn all the losses out already.
Exactly. So there will be a point where it doesn't make sense anymore. But a lot of people say, oh my gosh, it's been 3 years. I didn't know about it. In that scenario, most of the time it still makes sense and it still can be done.
Yeah. And that kind of speaks to sometimes we'll buy an asset and we're not super sure if we're going to be holding it long term. For us, 5 years, 7 years is long term for us. So that's why we may opt to not do a cost seg. But as AJ mentioned then, and he also mentioned at the top for those of you guys who weren't paying attention and taking a nap, you can taking advantage of bonus depreciation right now, all you had to do is acquire the asset from the years
2017 to the end of 2022.
Yeah. It's only the new acquisitions, 23, 24, 25 are subject to those lower step down.
Exactly. 23 is 80% bonus depreciation.
Yeah, thanks AJ for jumping on.
Of course, anytime.
All right, folks, it's just you and I now. If you guys want to check out using those guys' services, you guys can go to wealthelevator.com/cost seg. But yeah, a little bit of real talk here. These cost segs, they don't make sense for everybody. And if you're a LP, passive investor in syndications, you don't really have to worry about it because it all gets taken care of for you and optimized based on the experience of the general partner sponsor. But speaking more towards those guys who are looking to optimize their little rental properties, first off, I would say it really depends if how long you're going to hold on to the property. As I mentioned at the end there, even with our large apartments, we don't always do a cost segregation, especially if a asset is earmarked to be sold right away. As I've mentioned on more insider calls within our club, we're trying to move away from buying junky Class C and Class B assets because everybody's a multifamily syndicator these days, right? We've crossed over the $2 billion of assets owned, and there's a bunch of yahoos who are just doing whatever, and we're gravitating to different types of deals. And that's ultimately why for some of our more difficult assets, mainly the ones with the more difficult tenants who don't pay all the time, we'd probably look to unload those sooner than later. And therefore, the time length of ownership will be shorter, and therefore bringing this back to cost segregations, it doesn't make sense for us to burn up 10 grand when investors have to recapture that benefit within a short period of time. And every situation is different. Bringing this back to your guys' own individual rentals, don't just look at the benefit now. Is it worth you spending money to ultimately sell the asset next year or within a few years to give up the losses until you exit the asset? It's the crossover point's always a little bit different for people. Maybe if you held on to a property less than 2 to 3 years, it may likely not make sense to do one of these things. Secondly, is more your personal situation. This is a huge mistake I see passive investors making in syndication deals is they learn from us that passive losses are amazing and they offset passive income, but they go on this quest for searching out these deductions, but they don't need it. And I repeat, you may be a passive investor and you may not need passive activity losses for 1 or 2 reasons. First, your income is not that high, your AGI is not that high, and therefore you don't really have a need for passive activity losses. Let me actually display on the screen now for those of you guys checking out the video here. We're looking at the tax brackets here. To me, if you're over 364,000 for married filed jointly 2023 federal income tax brackets, it may make sense for you to do rep status and lower your taxes, and therefore having passive activity losses helps. But if you're under this threshold, you're not paying that much in taxes. Of course, if you haven't had your onboarding call with me, this is where we go to run through this really quickly. I can typically run somebody through this and have them getting the understanding to now have the empowered call with their CPA. Ultimately, most people change their CPAs. But the important thing that to me is you guys learn this. And again, like that's a marketing trick too, right? Hey, you get all these losses from these real estate, but if it doesn't pertain to you, don't go on this fetch quest for passive losses. Don't let the tax tail wag the dog. And another thing is if you're not doing rep status, even if you have a boatload of passive activity losses, it's just gonna rot on your 8582 form and be suspended up in the cloud, as I say, and you're not gonna be able to use it to lower your AGI. So again, you're not making a high income over $360,000 AGI, or heck, even over $400,000 AGI, and you're not doing rep status. Don't go around on these fetch quests looking for all these passive activity losses and cost segging all your stuff out. It doesn't make sense. The last point I want to make is this all could be a moot point with you doing a cost seg on your rental properties, because most accredited investors, once they start making multiple six figures, or we have some younger dentists and doctors who don't have any net worth, or certainly when your net worth surpasses getting off the ground, or as I call it in the wealth elevator, getting out of the basement or the first floor. You guys can check up the book on that with the chart where you fall. But if you're in that beginning stage of the wealth building journey and off the ground, you're going to get rid of those little silly rental properties sooner than later. You probably should do it sooner. And therefore, if you did a cost seg today and you sell it tomorrow, that would be a waste of money. Even if you did the cost seg today and sold it in 2 or 3 years, it's a waste of money. So you have to take that into account. Where you are heading in the future is most accredited investors realize, especially once they get around our ecosystem and talking to other real passive investors, owning your own rental properties just aren't scalable, and it's high liability, which becomes more of a focus for high net worth investors when you actually have something to be sued for and you have something to lose. But that's kind of me on my soapbox. Cost segs are great, but it's not for every situation. A lot of this has to do with the tax bracketology, which I feel like is, for me, fun, right? When I jump on the calls with you guys. If you guys haven't yet joined our club, get ingrained in our community, get your free complimentary onboarding call to go through this and learn this yourself, and then take what you learn and have that educated, empowered conversation with your CPA. Again, and we'll see you guys next time. Bye.